Markets have lurched this year with a number of surprises, from the introduction of negative interest rates by the Bank of Japan in January through to June's Brexit vote and last Friday's attempted coup in Turkey. Richard Turnill, Global Chief Investment Strategist of BlackRock, joins me today to discuss what we can expect and where there is some opportunities for investors in this world where the S&P is at an all-time high and bond yields are at a record low. Welcome, Richard.
Thank you.
Thanks very much for coming in. To take a look today at the first chart that you've brought in, which sort of puts some of these events in context. So we're watching central bankers to see what they're doing. We're watching the U.S. elections. But what, as investors, should we be watching?
So we've seen a significant spike in political uncertainty over recent weeks, particularly associated with Brexit, but actually there's broader uncertainties going forward. So over the next 15 months, we're going to see elections in France, in the Netherlands, in Germany, and of course in the United States. And that heightened uncertainty about those elections is likely to keep economic growth relatively subdued. So we've seen investment spending being constrained for some time. So there's already been an exceptionally slow economic recovery from the global financial crisis. It's been slow because corporates have been reluctant to spend, haven't had the confidence to spend, and this prolonged period of political uncertainty is likely to continue to keep investment spending rather depressed.
Okay. And what else do we know? I mean, there's a lot of risks around the elections, as you said, but what are the things that we can sort of expect? Maybe not for certain, but more likely than not?
Well, we're likely to see slower economic growth. We know that, particularly here in the UK and in the rest of the Eurozone. We've been in this low growth environment for some time. But one of the things we can be confident of is we're going to see a policy response to that. So the outlook for interest rates going forward, I think, is one of lower interest rates for much longer than we'd previously anticipated.
Okay, do we have a chart that shows, I think the next chart shows our government bond yields.
So since over the last few weeks, you've seen a significant fall in interest rate expectations, actually in most countries around the world. So it's been most evident here in the UK, where we'd now anticipate the Bank of England to cut rates at the next meeting in August. We were effectively told they were very likely to do that at the last meeting. In the rest of the Eurozone, though, we would expect to see further loose monetary policy, actually more in the form of quantitative easing rather than lower interest rates. Japan, we're expecting more quantitative easing going forward as well. And importantly, in the US, where we were anticipating a rate hike, the Fed has effectively said it's on hold now until at least December, so a prolonged period of stable interest rates. So a much lower interest rate, more supportive monetary policy environment going forward. However, I think what markets are going to be focusing on is whether monetary policy alone is sufficient to reflate the economy. Actually, recent market moves tell you the markets are perhaps overconfident that monetary policy can support the economy in the markets. We'd be looking for more evidence that the policy emphasis shifts away from monetary policy towards fiscal policy and structural reform that's really needed if we're going to see an acceleration in global growth.
And given that sort of environment, where would you be putting money? Where would you suggest to invest? If we take a look at the next chart that you've brought in.
So we believe this is a low return environment. That's most evident in fixed income markets, where you now have 2/3 of fixed income markets trading with yields below 1%. So we'd focus on three key areas. So within equities, we'd focus on quality and on dividend yield in particular. But in fixed income, we'd focus on investment grade credit. We still think you're being paid a sufficiently attractive premium to invest in high quality corporate bonds like investment grade, but increasingly also emerging market debt. So what you see here in this chart is that in a world where yield is increasingly scarce and where the need for yield, the need for income is greater than ever. So you see that need from insurance companies, you see it from pension funds, you see it from individual investors who are saving for retirement, then they've got fewer and fewer choices of where to get that yield. And actually emerging markets today really stand out as an attractive source of income. And in particular, three of the big headwinds for emerging markets have faded. So those headwinds are rising US interest rates, we've already talked about that. Headwinds are at falling commodity prices, so we believe that oil prices now stabilizing in that $40 to $50 range. And then the third big headwind has been China, where there's been a lot of concerns about Chinese slowdown, Chinese devaluation. Actually, the recent Chinese data has been much more encouraging, and the Chinese policy outlook looks more stable. So those three big headwinds have gone away, and we think that creates an attractive opportunity for investors in emerging market debt.
Excellent. Thanks very much, Richard.
Thank you.